Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney says his support for U.S. military action in Iran came with regret, adding that the current conflict is another example of the failure of the international order. Speaking at a news conference in Sydney, Australia, Carney talked about the need to prevent Iran from acquiring nuclear weapons, but said the U.S. and Israel acted without engaging the United Nations.
It's for the United States and Israel to make the case. And for whether or not that is the case. And it's for others, more expert than me, non-lawyer, certainly non-international lawyer, who are more expert to make that determination. And that said, well, Canada was not asked to participate. You know that. We were not informed in advance. We were not asked to participate. Prima facie, it appears that these actions are inconsistent with international law.
Shares of SSR Mining are seeing a surge. The Canadian precious metals producer is selling its 80% ownership stake in the Copper mine in Turkey. The cash deal worth $1.5 billion US will see SSR sell the mine to one of Turkey's largest industrial companies. The miner plans to use the proceeds for reinvestment, capital returns, and growth initiatives. Shares in George Weston are down after the company missed revenue and profit estimates in the latest quarter. It's up about 4%. The results were driven by a miss on revenue at Loblaw, as well as its real estate unit. Weston says the quarter was also affected by some liabilities. On the upside, it expects earnings to increase from operating segments and says it will use excess cash to repurchase shares. Well, what a difference 24 hours makes. The TSX on the way up. At this time yesterday, it was down 3.3% instead. It's up about 0.76% right now as people take a look at what is unfolding in the Middle East and try to figure out where to go next. For now, the markets are going up. South of the border, similar situation. Also some good numbers released today. You can see the S&P 500 up by about 0.9. The Dow by 0.66, and the Nasdaq is up by 1.44. So amid the surging oil volatility and geopolitical tension, my next guest says the conflict in the Middle East signals deeper geopolitical shifts that may reshape energy investing. Let's hear more about this from Rebecca Telcher, portfolio manager from New Haven Asset Management. Rebecca, thanks as always for joining us.
Thanks for having me.
All right, elaborate on the shift that you think we're going to be seeing.
Yeah, I mean, it's been an interesting couple of days. And, some of the issues that we're seeing in the markets right now were actually playing out prior to, the geopolitical escalation. Notably, the shift away from, let's just say, software stocks and back into more defensive stocks, shift away from U.S. equities and back into Canada. So that's, a shift that's already been underway, and we're kind of continuing to see that play out. With regards to the oil markets, we've already been seeing some disruptions happening in Russia over the past few years with the Russian-Ukraine conflict, then Venezuela, and now Iran. And so the question is, what does that mean for China? China has generally been the buyer of oil, mostly at a discounted rate with sanctions, for Venezuela and for Iran, and now with things, escalating in Russia again. So the question is, what does this mean for China, and where does that, play in? Are they suffering? How much storage do they have for energy, and when does that start getting depleted? And we're seeing that play out, in the Korean market as well, right? Like that market's down 18% in the past few days. And that's because they import 97% of their energy. So the question is, while they produce a lot of these memory chips needed for AI data centers, at what point, does energy become a problem and they're going to have to slow or halt production? So there's a lot of different moving parts here. And we didn't even, get into the idea of, rising energy prices and what that's going to do for the economy and inflation, because that's another leg there. And then that goes into the discussion about interest rates. So I'm kind of like spinning a little bit right now because those are all the things that are going on in my head at the same time.
Well, and we're trying to make guesstimates and estimates on things that may or may not happen. We heard from Trump that said this war he's not sure how long this will go on, and maybe weeks, maybe months. That scared the market yesterday. Today it's a little calmer. How do you even make a prediction right now on which way this is going to go?
You can't, right? That's the problem. And I think actually, the market, rightfully so, like they opened yesterday in a little bit of a panic. And then throughout the day, that panic seemed to have subsided. And, kind of like us, like we're just sitting on the sidelines. Like we need more before we're going to start making any investment decisions of, what to do, what to buy, what to sell. Like we're just kind of hanging tight and trying to assess more information, capitulating and trying to guess, what's going to happen in the next few days doesn't make sense. Maybe for short-term, traders, they're trying to capitalize on these situations. Us, we're long-term investors. So we rather try to gather the information first before making, a long-term decision. So, we're kind of just sitting on the sidelines and watching. I mean, we are invested in the market. We are defensive on a good day, and it feels really good to be defensive right now, especially. So, our stocks have not really seen that much volatility. If we do see more volatility in the next few days or few weeks, I mean, there may be some opportunities there to be able to add to our portfolio. But for now, we're just, sitting on the sidelines and watching as it unfolds.
And how long do you think you want to sit for? Like, what is there anything particular you're looking for other than peace in our time, something like that, which we may or may not hear? Like, how long can you sit before you have to start saying, well, we need to figure something out?
Markets are only down, 2% from their all-time highs. So if you think about that in the grand scheme of things, that's actually very little. I would want to see at least like a 10 to 15% correction before we start, seeing these valuations, become cheaper. Kind of like I mentioned at the beginning, we saw this shift earlier this year away from high valued, tech and software companies and into more defensive stocks. As a result, the names that we like, the more defensive names, the more infrastructure, backed, assets have gotten very expensive, or not expensive, but fully valued. So we're looking at, like the pipes, the utilities, they're all trading at pretty high valuations relative to its historical average. So before we start adding more, I want to see some of those valuations come off significantly, and not just, for a day or for an hour, like what we've seen, the past 2 days.
And one of the things you're staying away from right now, private equity, credit funds, concerns there?
Yeah, I mean, that's something I don't think is getting enough headlines in the market with just everything going on, geopolitically. But we've seen some, signs that there have been a lot of redemptions from some of these private credit funds, and these large private equity companies are, having to inject their own capital in there to try to, just trying to pay off those redemptions that are coming in. It's interesting because the private market is to me, it feels like a giant black box where it's not very transparent. It's hard to know exactly what's inside some of these funds. It's hard to know exactly what the valuation of these loans are, and whether they are good loans or are they bad loans, and are they liquid or are they not liquid? So there's a lot of questions there. But what we've seen in the past is when there is a scare in the market, or a scare for a specific asset, these liquidity runs can happen in fast and hard. And so again, that's another area that I'm glad to not be a part of. Just anecdotally from speaking to some clients or prospects, like they have some of their money invested in these private funds and they're not able to get their money out. Like the redemptions have been, locked or closed. So it's scary for, someone who's invested it for their retirement, thinking that this was like a safe or a diversified asset, to now only be told that they may not be able to get their money back.
Okay, we have to wrap it up there, but Rebecca, thank you as always for joining us.
Thank you so much for having me. Have a great day.
You too. Rebecca Telcher is Portfolio Manager at New Haven Asset Management. Up next, MDA Space is gaining after reporting record fourth quarter and full year revenues. The company's CEO, Mike Greenley, joins us after the break. Brampton, Ontario-based space technology company MDA Space plans to ramp up its satellite production facilities and seek more opportunities in the defense sector to take advantage of higher military spending. Joining us now for more on their plans is Mike Greenley, the CEO of MDA Space. Mike, thanks very much for joining us today.
Good morning.
I just want to talk quickly about some of your numbers. Lots to like there for you.
Yeah, absolutely. We just reported our year-end results. Things are revenue and profitability is up 50% year over year, and we continue on a strong growth trajectory as a company.
And let's talk a little bit that backlog, $4 billion at quarter end. What does that mean going into 2026 for you?
It means that we have really high visibility in our revenue for 2026. So the large majority of our revenue this year was already in backlog in signed contracts that we have in the business. Very stable foundation for the company. Our backlog levels are up 7 times the level they were at when we went public 5 years ago. And so that gives us really good predictability in our revenue as we head into the year.
And any concerns about being able to meet it, all the demand?
No, actually, no. We've hired a lot of folks in the last few years. We're up to over 4,000 employees now. We've done our new facility, completed, and are moved into our new facility in Brampton, Ontario, which is our space robotics center of excellence globally, and just completing and putting into operation our expanded manufacturing facilities in Montreal.
And now you focus, a lot of your focus for this year, CapEx. Where are we going to see that going?
CapEx this year will go into putting equipment into our new manufacturing facility in Montreal, in addition to some additional facilities here and there, and then investments into our product lines, the evolution of our product lines, our digital satellites, and our space robotics.
And how is that expansion in Montreal going?
It's going really well. We just put out some new little clips on social media under MDA Space, and just in the last few days, the facility is starting to become operational now as we go through the first few stages of the production cycle, where we create our own printed circuit boards, for example, and start to build units to populate satellite panels. Those first few stages are becoming operational now as we continue to set to work the remaining assembly equipment for the rest of the production line. As we go through the second half of the year, we'll have our full production facility operational and be capable of producing up to 2 digital satellites per day, which is a big leap over last year, which we were sort of 1 a week, and now we're going to be 10 a week this year.
And you have to fill it for me. Is there any production outside of Canada, or is it all in Canada?
Well, our satellite production facility is in Canada. It's in Montreal. And
it's nothing outside. Now you're at a great time right now. I mean, defense spending is going through the roof. Are you able to capitalize on that, or the proposal for defense spending is to go through the roof? Where are you looking? Canada obviously is a natural for you, and are you hitting down in the U.S. as well?
We've always had solid defense work in Canada and the U.S. That remains, but you're right. Canada is going through an expansion of its defense spending, and you said the promise of it, but it is actually starting to move. We signed a strategic agreement with the Department of National Defense and Telesat Corporation in the fall of 2025 to agree to work together on delivering the Arctic satellite communications for the North for the military, which is tremendously important. And so that's we're seeing the early signs of things starting to move and pick up pace. That's going to continue. Our pipeline indicates that. As a result of Canadian increased procurement, though, there's also increased opportunities internationally. You would have seen us sign a memorandum of understanding with Hanwha in South Korea recently to agree that as part of their pursuit of the Canadian submarine opportunity, that they would work with us to go after the Korean military communication satellites, to creating new export opportunities for us as a result of Canada importing certain technologies according to the new defense industrial strategy.
And with Canada, the Prime Minister was just in India, announced more cooperation with the ISRO, the Indian Space Agency. Do you see what opportunities do you see there?
I think that internationally there are solid opportunities for us. We're legitimate world leaders. As a third country that launched satellites into space, Canada was after the United States and the USSR. We're coming up to 60 years now of experience of building and orbiting space technology. And so we have a strong industrial base here in the country. So in certain areas like space-based communications, space-based Earth observation, space robotics and rovers, we have strong capability. As countries, with the geopolitical shifts that are occurring right now, countries want to be able to have increased Earth observation, to be able to monitor their sovereign territory, and they want to have sovereign communications, space-based communications, to be able to have sovereign communications across their country. Both of these areas are strong areas for Canada and MDA Space to deliver into as we do more work with countries around the world.
And you do work with the U.S. as well, with the defense down there. Any concerns about the friction between the two countries right now getting in the way?
No, we see full collaboration continuing to go on. We just announced recently in the last quarter a contract directly with the U.S. Missile Defense Agency on SHIELD, part of the Golden Dome program, as a Canadian company. So we're able to do that. We are a supplier to the prime contractors in the United States for the U.S. Department of Defense's SDA low Earth orbit constellations. All 5 U.S. defense primes buy satellite components from us that we ship from Montreal. So we still see strong collaboration moving forward. Our robotics and rover teams are teamed up with American firms to pursue NASA rover programs that we're waiting for decisions on. So lots of opportunities continue in the United States.
And with the situation in Iran, is that a concern? Is that an opportunity? Or how is that? What kind of an impact is it having for you?
Right now, no immediate impact. I think that as a pattern of behavior in the world, this sort of, the world is not a stable place, and conflict can emerge at any time. I think the activity of reaching out and striking other countries in the region causes everyone to want to ensure that they have solid situational awareness of their country and the threats to it, solid communications and the ability to respond. So all of these are benefiting from space-based technologies. And so countries will have seen satellites being highly involved in all of that action that we've seen in the last few weeks. So I think it helps reinforce the value of space-based defense and security and space-based sovereignty, which will only increase the pipeline globally as countries want to be able to increase their security state. Okay,
Mike, thank you very much for joining us today. We appreciate it.
Thank you. Appreciate the conversation.
Mike Greenlee is the CEO of MDA Space. Coming up, AI's winners are shifting from builders to beneficiaries. More on that when we come back. We may be entering a transition from the organizations that help build AI to those now directly benefiting from it. For more, we were joined earlier by Nate Tuft, CIO and Senior Portfolio Manager at Manulife Investment Management.
We've seen this powerful move driven by AI, particularly when it comes to companies that are building out the infrastructure, semiconductor names, the infrastructure plays that are building data centers, et cetera, where now we're seeing a lot more differentiation in AI, and there's a shift towards what we're calling the beneficiaries of AI. These are the companies that are going to be using AI to improve their cost structures, improve their margins, improve their potential growth opportunities, and being much more efficient in how they conduct business. And there's a number of sectors that benefit from that. Healthcare is an example where healthcare companies can benefit from the fact that they can develop drugs more quickly. They can diagnose diseases more quickly and more accurately. They can employ a much better data infrastructure around privacy and security. And so there's a lot of different areas of the market that we think are going to start utilizing AI as a means to improve their businesses. And most importantly, it will allow them to potentially expand margins by doing things more cheaply than they used to be able to do by incorporating AI as a tool into those processes.
Now, are these, would you call them early enablers, or is the product proving that it can work and they're just taking advantage of it?
I think if there is, it's still early from the fact that we're not seeing massive benefits at this stage, but we're definitely seeing deployment of AI into processes. And as we all know, the markets tend to react well in advance of when it actually happens. And so we are seeing early signs that our markets are starting to appreciate the fact that certain sectors will be much bigger beneficiaries and certain companies will be much bigger beneficiaries than others when it comes to using AI. And we can list a whole litany of those areas. We talked about healthcare. Another example is the banking industry. The banking industry has no shortage of data and processing dynamics that can be simplified, and banks are actively trying to do that through AI deployment by making things quicker, more efficient, and more accurate.
And is there a danger, though, of using it too early, or these companies are good? They're smart to be on the front line. Some of the other sector too as well. You wanted to get into industrial sector as well. I mean, we look at that as big machines, but how do they see a benefit from AI?
I don't think it's too early. There's always a little bit of a risk around governance and security and those types of things that companies have to think very carefully about when deploying AI. But at the same time, they need to be early because this is a competitive marketplace and you need to compete effectively. Your question about industrials, I think, is a great one because industrials isn't only benefiting from the AI story, it's also benefiting from the fact that we're seeing increased defense spending. We're seeing increases in CapEx related to energy and other types of commodity type of dynamics. So I think the industrial sector is an interesting play where there's a lot of companies that are not just benefiting from potential AI, but they're also benefiting from other things. I would point to the industrial sector as a sector that has the ability to help with the build out of AI. It has the ability to build out robotics, which uses AI. It's also one of the higher quality sectors that's more value oriented and has some of the best ROEs, particularly from a U.S. company perspective, where ROEs are traditionally north of 20+%. And so it is an interesting sector because it's hitting on a lot of lenses right now that the market is favoring.
And is there any one group or company that seems to be taking the most advantage of this and we're starting to see the results of it?
I think there's a couple areas. I mentioned defense. Now, this is partly driven by AI, but also just partly driven by the dynamics that we're seeing geopolitically, right? So the defense space is getting a lot of attention because there's a lot of dollars moving into that space, particularly with fiscal spending increasing globally from a lot of different countries. But when you look at it from more of a pure AI perspective, where I think we're seeing it most is companies that are building the infrastructure that's using AI, such as robotics in the manufacturing space. So there's a number of industrial companies in particular that are helping manufacturers and other supply chain dynamics build out the infrastructure using AI as a component to that, but building the machinery and the technology that allows them to facilitate that. So the two areas that we're most interested in, those companies that are benefiting from that, but also the defense companies that both use AI, but also are getting the benefit of dollars being spent by countries across the globe.
Okay, so where does this leave the tech companies then? I mean, if we're seeing that rotation out, where does this leave them? Are people going to stay with it, or are they going to pull all their money out now? I mean, they've had huge CapEx as planned, right?
Yeah, I think this is where we're going to see a lot more discernment, and we've already seen that. We're now seeing tech companies that are winning, and we're seeing tech companies that are losing. And we've seen no shortage of those over the last year. You look at names like an Oracle example. You look at names like Amazon and Apple and NVIDIA. Some of them have done really well where others have fallen behind a bit. And so that discernment and that differentiation is going to continue in our view. We are advocating to stay neutral to overweight tech companies. We're not advocating to be underweight. But one area that we're starting to move more towards is the companies that also will benefit from AI from a user perspective and from an implementation perspective. And this does include a broader array of companies beyond the early companies that were winning, where we had the NVIDIAs winning because of semiconductors. Now we're going to see other companies continue to win that are actually deploying AI and are viewed to be ahead of the game. Google as an example, and Apple as an example, Amazon as well. So there's a number of other plays beyond just the NVIDIAs in our view when it comes to the tech space looking forward.
And that was Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management. Coming up, we'll get some technical analysis of the markets after the break. Prime Minister Mark Carney says his support for U.S. military action in Iran came with regret, adding that the current conflict is another example of the failure of the international order. Speaking at a news conference in Sydney, Carney said the need to prevent Iran from acquiring nuclear weapons was important, but the U.S. and Israel acted without engaging the United Nations. We are watching shares of MDA Space today. It's up about 5.4%. The company logged higher profit and revenue in the fourth quarter as increased defense spending pushed demand. Revenue was 44% from a year earlier, boosted by its satellite business. The space company says it is benefiting from a partnership agreement to develop and deliver military satellite communications for Canadian forces in the Arctic, as well as a contract from the U.S. Missile Defense Agency. Shares of Abercrombie and Fitch are falling. They're down about 3.5%. The apparel retailer warns there will be a greater tariff impact on profit, as well as a slowdown in sales growth for the full year. Fourth quarter same-store sales also missed expectations, with growth in its Hollister brand failing to meet estimates. And taking a look at the markets, a little calmer day today. The TSX recovering from that big hit it took yesterday, where it lost about 2.2%. It's up 0.57% right now. South of the border, everybody's in the green there. The S&P 500 up by 0.77, Dow Jones 0.62, and the Nasdaq up by 1.3. Time now for a technical look at the markets. Joining us is Sid Bakhtari, Chief Market Technician at CIBC Capital Markets. Sid, thanks very much for joining us.
Thanks for having me.
A very interesting time. How are you approaching what's unfolding right now?
So we think we are in a transitioning cycle that is often associated with late stage patterns, i.e. This is a cycle that has begun showing a preference toward commodities, industrial, transportation, even by some measure, utilities and staples in the back end of it. So we think this late cycle transitioning will bring about some volatility, and at the risk of stating the obvious, some of the tariff negotiations or some of the geopolitics that is happening. All that is part of, in our opinion, is part of this late stage cycle that we have been witnessing over the past, call it 12 months.
And how, when you say late stage, whereabouts within the late stage would you say we are?
That's a good question. I think late stage cycles are often tied to inflationary, reflationary growth that be tied to economic ISM numbers over 52, 55 that again boost industrial production as well as need and demand for transportation, if you will. All that is part of a growth narrative that should come into the market, and it's typically inflationary, and eventually the talk of rate cuts will probably stagnate, and we may go into a period where there are no more cuts per se, and maybe the rest would be more about a rate hike at some point. Too early to talk about any of those things, but at least the market is beginning to show some of those historical evidence that we are in a more favorable environment that has a growth backdrop tied to commodities, reflationary bias, industrials, transportation. Those are the kind of areas that we're seeing that perform performing better with durable technical indicators, breadth conditions. That's where we have been focusing over the past, call it, few months.
And is the focus strictly commodities?
Not just commodities, anything that is tied to commodities and associated areas, i.e. industrials, as well as transportation. But generally speaking, commodities are the initial source of signaling process for us. We've seen base metals that are participating better. Obviously, gold and silver were the primary dominant drivers of the commodities boost, but we have now seen participation from commodities like aluminium, zinc, and coppers of the world. We're now seeing a big surge in breadth of the energy sector, and these are all typically associated with a cycling through a late stage narrative by historical measures.
Okay, and we have some sub indices that we can pull up. Any ones you want to focus on particularly?
I think industrials would be a very good area of focus for us, as well as maybe energy, along with if you got base metals, that would show quite well too.
We've got first up is
industrials would be a good.
Industrials is the first one up there, Sid.
Oh, perfect. So technically speaking, as you would agree, going back historically, you are at fresh new all-time highs. We saw similar patterns within the U.S. Transportation that finally, after 4 years of a sideways pattern, confirmed the U.S. industrials, and that's called the Dow theory signal. Again, that itself is a condition often associated with the late cycle patterns. But industrials in general are showing a very strong breadth environment. They're showing a lot of good quant factors. Trend oscillators have also been very supportive for durability of relative and absolute performance within the industrials complex. So I would say that's one area that we are heavily focusing, not just in Canada, but also in the U.S., as well as Japan and other areas around the globe. Industrials are certainly a good area of focus for investors.
And is that because, pulling that chart back up, they've been fairly flat, haven't they, for the last year? Little bit.
Correct. Within industrials, if you look at that's because of the composition of the index, if you would agree. There are, within the industrials, there were the likes of rails, that heavyweights of the index, as well as the waste management companies that are heavyweight within the industrial sector. Those were, somewhat stagnant or sideways, so kept this, sector chart more on the flat side. Within it, you've seen, things like EIFs, and MDA and other nichier areas in industrials that have worked quite well. So if we approach industrials from a more stock specific selective process and not necessarily passive process, I think you'll be able to be surprised how strong the sector would have produced alpha for us.
All right. And what was the other chart you wanted to pull up? Was it energy?
Sure. We can also look at the energy sector.
All right, let's take a quick look at that.
Because at the risk of stating the obvious, as you would agree, geopolitics have had a major influence of the performance of the sector. But we also want to say that we know that based on historical measures, between late March through to early June, the sector has a very strong seasonal hit rate at about 70%, with an average return of about 2 and a change per month. So this is an area that not only shows well on charts, shows well on its internals from a breadth perspective. We're looking at about a 90% breadth expansion. In other words, broader constituents of the energy sector are now above their 20-day, above their 50-day, above the 200-day. It's a condition that is historically associated with dip buying. We do assume pullbacks within the sector will be well received from a dip buying perspective, as well as the fact that seasonality backdrop is supportive all the way into, call it, late May, early June.
Okay, we have to wrap it up there, Sid, but thanks as always for joining us.
Thanks for having me.
Sid Mokhtari is Chief Market Technician at CIBC Capital Markets. Coming up, geopolitical fallout from the war in Iran is shaking up markets and adding fresh volatility as investors digest earnings. We'll have more on that when we come back. Aside from market uncertainty because of the war in Iran, investors have more earnings results to unpack this morning, including MDA Space, George Weston, and CrowdStrike. We got more from Grant White, portfolio manager at Endeavor Wealth Management.
The tragedy of the events that is going on from a market perspective. Markets have very short memories for these types of geopolitical events, and so you want to be very careful. I mean, I've had a few emails from some investors talking about this as well, and showing some concerns, and that's natural, obviously. But it is something you want to be really, really careful about right now. I think that volatility can really be your ally, though. I mean, if you're a disciplined investor, one of the things you got to be looking for right now, and we've been talking about this for months, but fundamentals are really climbing to the top here, and I think you want to focus on those fundamentals, and if you can find good opportunities to buy in because of volatility, then that's a great thing for you as an investor. So you want to be very disciplined right now, because the headlines can be scary, but that doesn't necessarily mean that it's going to be a long-term impact on your portfolio.
Let's get on to some companies reporting. MDA Space, what jumped out for you with those numbers, Grant?
MDA Space is this company that I love. I mean, this is a really great Canadian story, and if you're interested in the economy of space, MDA Space has to be on your radar screens. So this is a great company with a lot of Canadian history in space. The Canadarm 2. This is the company that brought that to life. And today they are big in the satellite game, telecommunication satellites. What stood out to me in the earnings is what we're really looking for is that continued flow of upcoming business, that pipeline of upcoming business, and how consistent that's going to be. And what's looking really strong out of that is we are seeing consistency there. And so I'm very optimistic about this company going forward. We have it as a buy rating. Now, it's a buy with a little bit of volatility to be considered. So I think that there is going to be volatility in this company, but it's very well managed. They do a great job. And I think the economy space is just picking up steam. And this is a great Canadian story at the forefront of it.
Quite the jump. Revenue surging 44%. And so the geointelligence is one of their big businesses, robotics, and then satellite systems. And Desjardins is saying once again, satellite systems was the star performer.
Yeah, satellites, telecommunications satellites, but I mean, defense spending as well. We know that defense spending is going up in many parts of the world right now. And a company like MDA Space, which builds satellites with defense in mind, is going to do probably pretty well in that. And that's also why we're seeing that pipeline of upcoming projects looking so strong as well.
And their backlog apparently is above 4%. It was down 9% quarter on quarter, but Desjardins doesn't see this as a real problem. Apparently, it excludes, for example, RadarSat Plus business.
Yeah, we don't see it as a problem either. I mean, again, what we were looking for is consistency going forward, and the ability for them to execute on that. And I think that that's exactly what we're still seeing from this report too. So still a very strong report from a great company.
What about CrowdStrike? What should investors pay attention to there?
Yeah, CrowdStrike is another really great company. I mean, they are one of the best in the game at what they do, cybersecurity. They're one of the best in the world at it. So it's a decent report that we saw from them. The real challenge we find with CrowdStrike is pricing more than anything. I mean, I think that they have great growth. We've seen that year over year, but that great growth is priced in at this point. And so what we're looking at there is, can we get in at a good entry point? Now, this is a company that if volatility does help us out and brings price lower, it's definitely a company that we're looking at very closely, that we would be interested in. Right now, we just find it a challenging entry point just from the pricing perspective. But outside of that, it's a fantastic business. They've done very well, and we expect that they're going to continue to grow at a reasonable rate going forward.
The George Weston, it's really the definition of a Canadian blue chip stock, controlled by the Weston family and Loblaw. They have that vast stake in that company. You reckon it's not that cheap?
Yeah, it's not that expensive, but it's not that cheap either. I mean, when we look at it from a pricing compared to historical averages, I mean, if you're looking at, price to earnings or other metrics, we're trading slightly above historical averages there. And so, I mean, it's a great defensive stock, though, at the same time. I mean, we know this company, it's it's essentially recession-proof with the businesses that they hold. And so, if you're looking at good core holdings, George Weston is a good company that many people across Canada will own. But in saying that, we don't expect that we're going to see a great growth uptick on it from a share price perspective, especially not at this price point right now. So it's a very good defensive stock. It's going to chug along. I don't see any concerns with it. I mean, the report was fine. It was okay. There was nothing that stood out to me that said, hey, this is something that we need to jump into at this point. So it's a good defensive stock that you can feel very comfortable owning. And if the price does come down a little bit, yeah, it's something we might add to. But just at this point, it's just a little bit expensive for what the company is. And when we're looking at yields on it as well, there's nothing super attractive on it. It's an okay dividend yield. If you include the share buybacks, you're closing in on about 3% total yield. But overall, it's nothing to write home about right now. I think there's better opportunities elsewhere.
And finally, what are your thoughts on Apple these days?
I think Apple is such an interesting company. I think it's one of those companies that really is going to surprise people. I mean, they've been waiting in the weeds and then playing that typical Apple playbook, I think, as it relates to AI. Now, we're seeing a lot of really strong releases come out this week with the M5 chip being implemented into a lot of devices, and there's more to come. So I like Apple because I think it's the sleeper pick in this AI race. And I think with their user base, what they're capable of, what they've been able to execute in the past, and what I know they can execute going forward, I think they might be the ultimate winner in still being the ultimate entry point for AI for most consumers. And so with all that said, I think Apple might be a really great winner over the next year or two as it rolls out these new devices and implements AI into their system. They've been slow. We all know that. And I think the share price has been punished because of that. But I think that's also giving us an opportunity to look at this company again. And it's a fantastic business, as we know.
So they've been rolling out multiple products. There's speculation that they're going to unveil, and maybe I'm even behind the eight ball here, a new lower-cost MacBook today. Yeah. Although the company, they're saying we're hosting an experience today in New York. In any case,
yeah, I think we're all watching it. I think it's going to be very interesting, and I think some of that magic might be coming back into Apple. It's not like back in the iPhone release days early on when Steve Jobs would do this, but I think that there is something to be excited about going forward with Apple, and that ecosystem of devices they have is really perfect to implement and execute this AI strategy. So if they can execute well, which I believe they can, then I think Apple's going to be one to watch for going forward, and it might be the central hub of how over 2 billion people access AI.
Andrew was speaking with Grant White, portfolio manager at Endeavour Wealth Management. Just ahead, the latest developments in Canada's defence strategy as the country has some big decisions over the coming months to replace Canada's aging submarines and fighter jets. Foreign Affairs Minister Anita Anand delivered a keynote speech to the Ottawa Conference on Defence and Security today. We got more from CTV's Jeremy Sherrill.
We heard the minister this morning focus on kind of three key priorities she says the government has established so far, or at least themes she wanted to touch on this morning. And they are Ukraine, the Arctic, and the Middle East. The minister highlighting support that Canada has given to Ukraine in that ongoing war, touched on investments in the Arctic and a commitment to help further secure the Arctic, including her recent visit to Nook, Greenland, to open a consulate. The minister also touching on the situation right now in the Middle East and reiterating a lot of what we have heard so far from the Prime Minister on Canada's position. But this conference is one that is focusing, Andy, on defense spending specifically and new NATO commitments. At the 2025 summit in The Hague, a new pledge was made for countries, NATO allies or NATO members, to reach a new defense spending target of 5% of GDP. Now, Canada has accelerated its prior target that it had not yet met of 2%, and it is expected that by the end of this month, in March, that the federal government will meet that target of spending 2% of its GDP on defense. The minister reiterated Canada's commitment to increasing that further to meet the eventual requirement of 5% of spending GDP on defense, and that target is for, again, 2035, but would require require more than $30 billion in additional annual spending on defense to get there. But the minister recommitting this morning that the federal government still pledges to get to that target, and that they are still focused on doing so. So that means significant investments are ahead, and there are big questions about where to spend that money. Two of the places they can spend that money are submarines and fighter jets, Andy.
Right, and we're already buying, we kind of forget, we're already buying a bunch of the F-35s. The question is, do we buy more? But the Swedes are still in there pitching the Gripen jet.
Absolutely. To your point, we've already committed to and paid for 16 F-35s. The question is to complete the fleet that Canada is looking to acquire, which is a full fleet of 88 fighter jets, whether or not they continue to move forward with the American-made F-35s or opt for at least some of those jets to be of the Swedish Saab Gripen. And so there's a review still in place on what to do moving forward when it comes to acquiring that full fleet. It is not clear at this point when that decision will be made. What we do know now is that we are much closer to a decision on the submarines. Canada is looking to acquire a fleet of 12 submarines. March 2nd, so just days ago, was the deadline for companies to submit their final applications, if you will, or proposals. And we know that two did so, German's TKMS and the South Korean Hanwha company. Those are the two options that are on the table. CTV News has learned that June is roughly when we're expecting a decision to be made. And both of those include significant investments in the Canadian economy, incentives to go with their contract. We're talking about tens of billions of dollars here. It does not include, though, Andy, importantly, any commitment to establish manufacturing or supply chain for vehicles in the country. The industry minister, Melanie Joly, was pushing for either group to commit to establishing manufacturing for either German-made vehicles or South Korean-made vehicles here in Canada. That is not part of either proposal, we have learned.
And Andrew was speaking with CTV's Jeremy Sherrill. Market Call is coming up next, and today on the show we have John Zechner, chair and founder of J. Zechner Associates. He'll be taking your questions on North American large caps. And a quick look at the markets before we go. A bounce back from yesterday. The TSX up by 0.63, S&P 500 by 0.84, and look at the NASDAQ coming back. It's up by about 1.4%. And that is it for the morning markets. Thanks very much for joining us. We'll see you back here tomorrow.